Welcome to the Riskwiser Zone, the podcast where we dive into the world of finance, stocks, and global markets. I am your host, Louis, and we're glad you're joining us today. We've got a lot to cover, so let's get straight into it. We're seeing some significant developments in the trade war between the US and China, with the latest news indicating a 90-day reprieve from the steepest of Trump's China tariffs. This move has sparked a shipping rush, with companies restarting factory operations and ramping up production again in China. According to reports, Therabody, a Los Angeles-based maker of wellness products, has restarted manufacturing and is increasing production in China. The company's CEO, Mani Sharma, expressed relief at the tariff relief, stating that despite a 30% increase in costs, he's never been happier. This sentiment is likely shared by many businesses that have been impacted by the trade war. However, it's essential to note that this reprieve is only temporary, and the tariffs will remain in place after the 90-day period. The total weighted average U.S. tariff rate on Chinese products now stands around 43.5%, including pre-existing duties imposed in past years. For example, running shoes produced in China are still subject to a 47% tariff, up from 17% in January. The impact of these tariffs is being felt across the globe, with China's exports to the U.S. falling by over 20% in April compared to last year. However, overall Chinese exports to the world rose by 8.1% during that time, according to official data. As we navigate this complex and ever-changing landscape, it's crucial to stay informed and up-to-date on the latest developments. We'll continue to monitor the situation and provide you with in-depth analysis and insights. For now, let's take a quick break. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into our middle segment, where we explore the latest developments in the world of finance and risk management. Today, we're looking at a story that's making waves in the Indian market, where a brokerage firm is warning about expensive valuations despite a positive outlook. According to Pratik Gupta from Kotak Institutional Equities, India's sovereign rating upgrade by Morningstar is a positive sign, but it's not enough to trigger a significant rally in the markets. Instead, investors are waiting for the private capex cycle to pick up, which has been held back due to uncertainties in domestic politics, tariffs, and geopolitics. Gupta also notes that emerging markets, including India, may see a renewal in flows as investors start to look away from the U.S. and towards other regions. However, the timing of this is difficult to predict, and it's unclear whether it will happen in the next few months or later in the year. It's worth noting that while there are positive signs on the horizon, valuations remain a concern for many investors. The Indian market is still trading at expensive valuations, which may hold back some investors from entering the market. As we consider this story, it's essential to remember that risk management is key in any investment strategy. It's crucial to be aware of the potential risks and rewards associated with investing in emerging markets like India. We'll continue to monitor this situation and provide updates as more information becomes available. In the meantime, we encourage our listeners to stay informed and do their own research before making any investment decision. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. Today we've been exploring the complex world of global trade and its implications on economies around the world. As we wrap up this episode, let's take a closer look at the ongoing US-China trade war and its effects on Southeast Asian nations. The recent pause in the trade tensions between the US and China has brought some relief to countries like Malaysia, Vietnam, and the Philippines, which have been caught in the middle of the dispute. However, as our story highlights, these nations are still walking a fine line, trying to balance their relationships with both the U.S. and China. The Trump administration's demands for exclusive trade relationships and its threats of tariffs have put pressure on Southeast Asian countries to make difficult choices. Meanwhile, China is also pushing for closer ties with the region, urging ASEAN nations to join forces against U.S. tariffs. As we analyze this situation, it's essential to consider multiple perspectives. On one hand, the U.S. has legitimate concerns about intellectual property protection and trade imbalances. On the other hand, China's economic influence in the region is undeniable, and ASEAN countries have significant trade relationships with both nations. The recent 90-day pause in the U.S.-China trade war may provide a temporary reprieve, but it's unlikely to bring long-term stability. As our expert sources suggest, the timeline is tricky, and the pressure on Southeast Asian nations may ease or intensify depending on the outcome of the U.S.-China talks. As investors, it's crucial to stay informed about these developments and their potential impact on global markets. The pushback against President Trump's tariffs in Congress and the ongoing negotiations between the U.S. and China are key factors to watch. In conclusion, the U.S.-China trade war and its effects on Southeast Asia are complex and multifaceted. As we navigate this uncertain landscape, it's essential to remain cautious and adaptable. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.